I think the right time to buy a house is when you can comfortably afford to do so, regardless of what the market is doing, whether it's down or it's up. If you can comfortably afford it and you really want one, then great. But I do think about a home as prepaid consumption. I don't think about it like an investment in the traditional sense. First and foremost, because there's really no guarantee that it's going to go up in value. It'll probably keep pace with inflation. And depending on where you live in the world, it might go up in value. I mean, someone in San Francisco who bought in 2000s, like probably scoffing at this. But the reality is that my parents' house in Kentucky, it went up like 2 or 3% per year. They owned it for 25 years. They lost money on it. So I think this concept that we have, this recency bias that real estate only goes up and it goes up 10% per year. And if you don't own a house, you're never going to be wealthy. Like, I think those are all things that very much keep the lucrative real estate machine running, and rental property investing, totally different story. But I don't consider a primary residence an investment. I think, you'll probably get your money back out, but I wouldn't think about it or go into that decision thinking like, oh, it's okay if I spread myself really thin because it's an investment. I think we forget that those associated unrecoverable costs are also proportional to the value of that property. It's just one of those decisions where you really have to run the numbers and not be biased one way or the other. I think I am still a little bit biased toward renting because we are able to rent really nice places where we live for a lot less than we would have to spend to buy, particularly in this market. And I do think that for young people who have no equity right now, it's a hard market to buy into. I get nervous about people who are like, oh, I'm going to cash out my 401k to buy a house. It's like, I don't know that that is what I would suggest doing, but to each their own, right? Like, people's priorities with their money.
I think that's a super valuable thing, maybe to dive deep down, especially right now with home prices just, it seems to have cooled off now and people seem to have chilled out. But you have lots of stories about people offering crazy amounts above asking and a lot of just FOMO, fear of missing out. I kind of get the sense that maybe if you've been thinking about this for a while, you have other creative or, it seems to be such a black and white conversation. You rent or you buy, and you're almost like subject to whatever market you're in. But I mean, you mentioned San Francisco. What about like Southern California, where I was born and raised? I see a lot of friends and family first starting their careers and being like, this is insane. I don't know what to do. What would you speak on somebody who's in that situation, having been somewhere similar 5 years ago?
Yeah. If you want to get like really conspiracy theory about it, sorry, my cat's attacking me. This is what we do all day long as I sit here and try to work. I think a large part of the prices we're seeing right now, and obviously this is going to be exacerbated in the desirable places to live, right? Where I use the Bay Area because it's just like the most kind of stereotypical example of like really inflated cost of living. I think it all comes back to 2008, and I think the great financial crisis and the response from the Federal Reserve and the government to write off the mortgage-backed securities and kind of bail out the economy. Things would have gotten much, much worse had they not done that and written off all that bad debt. But I think as a response, it introduced this period of monetary policy where the response to everything was money printing. And it's like, I mean, obviously they're not literally printing more money, but injecting more liquidity into the system to try to keep things propped up. And I think what we saw post 2020, 2021 was the Federal Reserve and the government basically saying, the entire global economy is screeching to a halt or did screech to a halt. We need to inject liquidity so that things don't collapse. But then they kind of overdid it, in my opinion. This is my subjective opinion, but I do think that, they kind of overdid it and they overreacted a little bit. And so all of that money found its way into assets, both stocks and home prices. And I think the real estate market does lag the stock market. It's less real time, but I think the same kind of downturns and softening that we're seeing in equity markets are going to play out in the real estate markets as well. I think it just takes 6 months or 12 months. It takes a little bit longer for that to really like infiltrate in the same way. But I do think that the reality that we're facing now is that those who did not already own homes before the money printing started and didn't benefit from that asset inflation are now further behind the starting line. And so I do believe that there might have to be a bit of a recalibrating of expectations. And whether that means you are living in a place like Southern California or the Bay Area or New York City, and you might even have the fancy tech job or the hedge fund job that pays hundreds of thousands of dollars a year. Even you may feel like you cannot afford real estate. And I think that is the position that, it feels really unusual and really paradoxical to find yourself like with a really high income objectively and still kind of being like, I make $250,000 a year. I can't afford to buy a house. But that is kind of the reality of those cities. And I think in a lot of cases, particularly San Francisco, if we look at the price to rent ratio in that city, the price to rent ratio is 50, which means for the price you could pay to rent for 50 years, that's how much you would need to buy a house, as opposed to like Detroit, Michigan, where the price to rent ratio, I believe, is 6, where you could rent for 6 years or outright purchase a home. So I think it's such a hyper local decision that price to rent ratio is really, really helpful for localizing it and helping you understand like whether or not it is actually net cheaper to rent or net cheaper to buy. And I know it sounds really counterintuitive that it would ever be net cheaper to rent anywhere, but really if your price to rent ratio is at or below the low 20s, like at or below 22, we'll say, or, maybe all the way up to 25, then it's probably going to be cheaper to buy. But if you've got a price to rent ratio that's in the 30s, 40s, 50s, almost under no circumstances should you be buying if you're really worried about like the financial implications of that decision. And I think you could say that the longer you stay somewhere, the more it kind of evens out. And I think that's fair. Like if you intend to buy a home and then pay it off and live in it for the rest of your life, all right, that's a different story. But we know that that's not how Americans actually typically live. Like I think the average time in one home is 13 years. And I think for the first 10 or 12 years of owning a home, your payments are primarily interest anyway. So you're really just relying on appreciation outpacing kind of everything else because you're really not paying much towards your principal at that point. You're not making much of a dent in the first 10 years. So I think timing obviously plays a really big role, but I really like that price to rent ratio metric for helping to localize in those situations where it's like, okay, it feels like, a lot of the appreciation in this area has already happened. And sure, it might continue to go up. But if your price to entry is 10 times higher than the person that lived there before you, well, that means it has to go up a lot more for you to get the same types of returns in the future that they got.
So kind of like a shot in the dark. I mean, you're talking about flexible expectations. So I don't know if this is something that you have an opinion on one way or the other. Is it possible maybe if you are stuck in an area like that where you feel like there's no way you're going to get into a home, is a possibility maybe putting more into a 401k and thinking, hey, I can maybe be a homeowner much later stage of life than traditionally people have always said you should buy a home? I mean, we look at like the stereotypical 1950s where it was like, you had one breadwinner and everybody seemed to get a home with any sort of job. That doesn't seem to be the reality today. So, Can maybe people think about recalibrating in that way and still not be feel like they're behind the ball financially?
Oh, 100%. I think I love that you phrased it that way because I think it is very reflective of like America has evolved. The prices of things have evolved, whether that's thanks to late stage capitalism or monetary policy, like whatever you want to call it. We live in a very different time now. We don't own any property. We have $1 million in the stock market. Like I would under no circumstances consider myself financially behind because I don't own any property. And I know I'll own a house eventually when I decide, I'm ready to settle down and live in it for 10 to 15, 20 years. But at this point in our lives, we move around a lot still. Like every couple of years, we're moving somewhere else. So I think the difference really between the 1950s family and the family of today, the modern American family or person, is that in the 1950s, you couldn't, with the click of a button on your phone, invest in a cheap, broad-based index fund. The index fund didn't even exist yet. So in some ways, we have far more wealth building options available to us today than any other generation in history. It's never been easier. It's never been more accessible. and you've never needed less money to get started. So I think the reason we get that kind of traditional, conventional wisdom from generations past that like the home is the ultimate wealth building machine is because for them that was true for them. For us, I don't really believe that that's true anymore. And I think the benefits of investing in something like the stock market where your capital is liquid, you've got that flexibility. You can deploy it when you want, how you want. You are not tethered to one place. Like, I can't really even fathom the only way I can build wealth is if I live in one place for 30 years. Like, how limiting is that? I think in a lot of ways we have it better than previous generations did, but I know that that's hard to kind of reckon with or accept if, you've been socialized your entire life with this idea that unless you are a homeowner, you have somehow failed at adulthood or failed at like this big financial step you have to take.
I love that idea. Wow, that was great.